Back in early March, I was telling everyone who would listen that we were going to have a V-shaped recovery in the stock market, but even I wasn't expecting this. What's up, guys? It's Jeff. Today I'm talking about what's going on in the stock market and what I'm doing next. If you're new to the channel, please subscribe and turn on the notification bell. Also, if you could smash that like button, it would be much appreciated. It really does help the YouTube algorithm. And as always, I'm not a financial advisor, and this is not financial advice, just a summary of my thoughts and what I'm doing. So I thought things would go a little like this. We turn the economy off for a few months. The Fed then steps in to provide a bridge until we're ready to turn things back on, likely sometime by the end of the summer, and then things would slowly get back to normal by the end of the year. My sense was that there was going to be massive layoffs and some of those jobs would never come back. So based on this, I was expecting to see inflation in the financial economy, but not the real economy. I'll get into this in more detail in a few minutes. I was also expecting the S&P to go down to the 2100 level before recovering back up to 3000 by the end of the summer at the earliest, and more likely by the end of the year. So I've been right so far about the impact on the real economy, but only partly right on the stock market or financial economy, because while I expected a V-shape, I expected the market to go down more than it did, and I also didn't expect it to recover as quickly as it did. So the first thing I want to talk about is the real economy versus the financial economy or the stock market. Lots of people don't understand that the real economy is not the financial economy. They're two very different things. So here's the difference. The real economy is what's actually going on in the world on Main Street. It has to do with the health and wellness of all consumers and all businesses, including millions of small businesses. The financial economy, on the other hand, is all about Wall Street. And Wall Street is all about stocks and bonds of publicly traded companies. And they tend to be the biggest and best companies in the country. So for example, the S&P 500, that is an index of the 500 biggest publicly traded corporations in America. So basically, the stock market is made up of a small number of massive corporations, whereas the real economy is made up of millions of consumers and businesses. So the two have always been different, but even more so today because the stock market is now more concentrated than ever. So for example, the chart you see here, the top 5 companies in the S&P 500 today represent 20% of the market cap. Now, in the past 40 years, the average has been closer to 14%. So 20% is way higher than what we've seen recently. Now, the next thing I want to talk about is inflation, because it's crucial to understand that there are two types of inflation. Inflation in the real economy is the price of goods and services going up, while inflation in the financial economy is the price of assets going up, like stocks and bonds. So I said earlier that I expected that we were going to see massive inflation because central banks would be forced to print money on a global basis, just like they did back in 2009. Now, the major difference between 2009 and today is twofold. One, we're actually seeing stimulus checks go directly to consumers rather than just monetary stimulus to the financial system. And number two, regulators acted much more aggressively and much more quickly this time around than they did in 2009. And I suspect this happened because this time around there was no moral hazard. Now, in 2008, the crisis was caused by the bank's reckless behavior and risk-taking. So bailing them out represented significant moral hazard. Now, to give you an example of that, let's imagine a gambler who goes to a casino and loses $1,000. But every time they lose that money, the casino gives them another $1,000 to gamble with. Now, in this made-up example, that gambler has no downside risk because they know if they lose their money, the casino is just going to give it back to them, essentially bail them out. So they only have upside, which means they're highly incentivized to take on more risk. Now, this time around, we didn't have that. The banks are much more regulated and much less levered today, and they actually weren't the ones causing the problem. So in 2009, we saw massive inflation, but not in the real economy, because CPI has actually been quite low since then, but rather in the financial economy. Now, what that means is that instead of prices like things like milk and food going up, what we saw was the price of assets go up. So stocks, bonds, real estate, even things like wine, watches, and other collectibles. So to give you an example, When I started collecting watches, I could walk into a store and buy a Rolex, an AP, or a Patek at retail prices and sometimes even get a small discount to retail. Now, since 2015, that's been impossible. Now you can't even find some of the more popular and collectible watches at retail. You need to buy them in the gray market or the secondhand market at massive premiums, sometimes as much as 2 to 3 times retail, which is just absolutely crazy. So today we're seeing a little bit of price inflation because of supply chain issues and stimulus checks, but once again, the bulk of the inflation is in financial assets like stocks and bonds. The other interesting thing this time is that retail investors are not only participating in the stock market rally, but actually partly a cause of the rally. We're actually seeing a lot of first-time investors open up brokerage accounts and start investing their savings, surplus cash, or stimulus checks in the stock market. So where are we now? And what do we do next? So in the first half of 2020, we've seen small businesses get decimated, especially in the hospitality industry, everything from restaurants and movie theaters to airlines and hotels. So the V-shaped recovery has not and will not apply to them because no matter what the government does, it can't force people to go to restaurants and to travel. All the government can do is ensure the banking system and credit markets remain uninterrupted and provide consumers with some stimulus. So America today is on the verge of reopening, but will likely continue to see layoffs, and people will certainly continue to be concerned to be in crowds. Now let's look at China, for example. They've been open for the last month or two, and their government's been successful in getting people back to work, but not back to leisure. So the country is essentially shut down on weekends, and that's proven out by traffic patterns, which have returned to normal levels during the week, but are still down 80 to 90% on weekends. Now moving back to the US, on the business front, large corporations have the resources to weather the storm, and they have the infrastructure required to continue to have their workers working remotely from home and deliver their products and services to their customers, either physically, like Amazon, or online, like Google, YouTube, Netflix. So what generally happens in a time like this is a fundamental shift where industries naturally consolidate as the weaker competitors simply shut down or go out of business. So what happens is the weak get weaker and the strong get stronger. So that's another reason we're seeing such a vast difference between the real economy and the stock market. The problem right now is that we have somewhere north of 20% unemployment in the country, and some of these jobs won't come back. So what are these people going to do, and what impact will this have? Well, unfortunately, we just don't know yet. So I continue to be cautious about the stock market right now because of the factors that I mentioned. On the bull side, it looks like we're about to reopen many parts of the country, people are getting back to work, and life is slowly starting to normalize. And more importantly, we have a very aggressive Fed and Treasury that have told us that they'll do whatever it takes. Now, on the bear side, we have very high stock market valuations and continued uncertainty on where the real economy is headed. Now, I lived through the tech bubble of the late 90s and early 2000s, and this feels a lot like it did back then in terms of tech valuations. So I can't tell you what to do because everyone's in a different financial situation and in different stages of their lives, but I can tell you 3 things with a great deal of certainty. Number 1, in 10 years, the stock market will very likely be higher than it is today. Number 2, if you need cash in the short term, the stock market is never a good place to park money. And number 3, if you do an upside-downside analysis on the overall stock market right now, the upside is somewhere between 5 or 10% before we get back to all-time highs. Now, I don't know exactly what the downside looked like, but I can tell you that it's significantly more than 5 to 10%. So right now, the risk is definitely to the downside. So with all that in mind, here's what I'm doing. Number 1 is I'm building up dry powder. That basically means that I'm just hoarding cash, because in times like this, when we have an uncertain economy and when valuations get stretched, you definitely want to have cash to take advantage of any sell-offs should they happen. So what I'm doing is I'm taking profits where stocks have run up massively. So if I'm up 50% or more on a stock over the last month or two, chances are I'm taking a little bit of money off the table. The other thing that I'm doing is cutting my expenses dramatically. If I don't need to spend the money, I'm not spending it and I'm saving it instead. Number 2, I continue to buy, but very selectively and just very small amounts of my absolute favorite stocks, and only when their prices go down. So I just mentioned before that I'm saving as much cash as I can. So all of the extra disposable income that I have that comes in, I put that in one of 3 things: either cash, gold, or Bitcoin. And then when one of my favorite stocks goes down in prices, I'll use some of that cash or sell down gold and Bitcoin to buy more shares of that stock that I like. So right now, I'm specifically staying away from businesses that require crowds to make profits. So the obvious ones there are airlines, cruise lines, commercial real estate, and restaurants. So what do I like? Well, I've identified a few trends that I think are here to stay. Number 1, work from home. It's easy to do. We have the technology. People have experience with it now. It gets rid of commuting. It's great for the environment, and it saves employers a ton of money. So the obvious thing to do here is to buy stay-at-home stocks. The problem is that that's so obvious and easy to do that a lot of these stocks have already rallied dramatically, so it's really tough to find good value in that space. One area that hasn't rallied as much is residential real estate. Now, as more people work from home, they'll naturally want to have bigger and nicer homes. It's much more difficult to buy a home even in the best of times. So at a time like this, where it's difficult to even just go see a house, and where it's difficult to get a mortgage because the banks are so busy doing other things, you can imagine that it's just more generally difficult right now. So if you can buy an investment property for a good price that cash flows from day one, that's probably a good place to invest. Number 2, big tech. So big tech is actually relatively cheap compared to the broader market, and especially compared to the broader tech market, and then especially when you factor in risk. I don't know where big tech is going to go in the short term, if it's going to go up or down. I have no idea. But I do continue to expect good things from them, especially in the long run. And finally, number 3, secular growth themes and disruptive technology. There's 4 themes here that I particularly like. Number 1 is less reliance on people to do simple tasks that can be automated. So obviously the winners there are automation, transportation as a service, and software as a service. The next theme is continued migration online. So again, the obvious winners here are cloud, 5G, and mobile infrastructure, and online payments. The third one is moving away from cash towards digital money. So here again, obvious winners are blockchain and payment providers. And then finally, the fourth, a move away from fossil fuels to renewable energy. I think we all know the big name in that space. So if you guys are interested in hearing some of my favorite stocks and hearing a bit more depth on my investment rationale, please comment below and I'll be happy to make a video. So I hope you guys enjoyed today's video and found it helpful. If you did, please make sure to like the video. And as always, thanks for watching, stay safe, and have an awesome day.